Their, their husband, husband, no, okay, it's all good, yeah, fine. All right, I'm in practice session. I'm gonna hop out of it because, does it? No, you said it takes about 30 seconds? Oh, hang on for a minute. Still trying to figure out what I see here in the background. Oh, I know what I need to do. This was a good thing. Sorbet magazine. Might as well talk about that, don't you think? Hey, do we have an electronic? Was that what we got? Okay, you have one. Does it look okay? I mean, can we scan it and do better? Okay, all right, because someone asked me for that. All right, here we go. I'm jumping on. Hello, everybody. 3 o'clock straight up here on the West Coast. I'm Jerry Slusowitz, your host. Appreciate everybody joining in. Today we're talking about financial defense, making your money last, or will your money last as long as you do? Again, I appreciate everybody joining us today. Just a couple of housekeeping things. On the bottom, you have Q&A, and then you have a chat button. You click either one of those, and I'll take your question along the way. As much as possible, something I'm getting to, I'll tell you I'm getting to that next, and we'll make sure we cover all the questions. I'll reread the question for everybody. So if you got a question about anything for today's market or anything along the topics that we're talking about, financial defense, making your money last, please don't hesitate to go Q&A or chat, and I'll review this later on because it's kind of like a Dodger game. People usually get here in about the third inning, and we're just at the very, very first pitch starting out. For those of you on here that don't know me, I'm Jerry Slusowitz. I'm a host of this program. We've been doing this ever since COVID began, probably, will there be 21, 2, and 3. So this is probably our 4th year that we're doing this. And I still need Nancy because I don't know how to do most of the stuff. So, if I ever yell out for Nancy, she's helping me from the technical point of view. All right, so like I said, I'll take your questions as we go forward. Be glad to help you in any way possible. But the topic is really important because people worry about money. I mean, it's a fact. They say that 65% of people worry about money, and probably the other 35% don't have any, so they don't worry about it because they already know they don't have it. But it is something that's causes divorce, causes angst, causes anxiety, and it's not a matter of rich or poor. It really isn't. I was one time asked, well, how do you manage money? Is it based on how much money they have with you? And it's no, it's really income versus people who don't need income, could be growth or in the balanced account, which is where most of my clients are. They might need some income, but they don't want to take too much risk in the growth portfolio. So it's one of those three. As a matter of fact, we're talking about rich people worrying about money. How much do rich people worry about money? And wealthy people worry about money too. It's something like 25 to 30% of wealthy people worry about money. Let me give you an example. I have an insurance buddy of mine. We've been doing business together for about 30 years. We refer each other business. We do a lot of joint work is what it really is. It's not like we refer each other. We do it together. So he brought me in on this deal that we're working on right now that we're bringing in the assets as we speak. And it's about $20 million. Pretty good. A lot of money. This guy's selling his business downtown LA, the homeless issues getting to him, etc. So he's selling the business. He's going to clear after taxes $20 million, right? Seemed like a lot of money. The guy's 74 years old. His wife is 69 years old. Wow. Most of us here on this call, if we had 20 million in liquid cash coming in the next couple of months, we'd be pretty happy about it. We had to sit down and tell this guy, that's probably why we got the deal, because we're realistic. If he gets a 5% rate of return on his money's going to run out of money in 20 years. So his wife would be 89. People are living longer. So we're talking about financial defense, make your money last. He would be like 94, but he's got like 3 kids, and he'd be flat broke other than his house. If he gets 7% return, that's only going to give him another 2 years. He's going to be broke in 22 years. Why? It's not about the money. It's about the income that he needs. It's about the lifestyle that you've established, and how much does that lifestyle cost? A lot of us on here are retired, but some aren't. And you got to figure out, what can I afford in retirement? That's why having a retirement income analysis is so important at every stage of your life. You want to just see where you are in terms of having some sort of analysis on your income needs. And I know you guys, some of you have been on here a bunch of times, but I'm going to show it to you anyways. Let me get this up here, the whiteboard. And this is really what it comes down to, is you have income coming in, and hopefully Mar's not on here because he'd be upset that I didn't do this ahead of time. All right, income and expenses, right? And then here's your assets. So in this guy's case, he's got 20 million, all right? You would think that 20 million would be enough, but because his expenses are about 2.2 million per year, and his income's about $1.1 million a year, his expenses are so much greater that his rate of withdrawal is, very high. And with that happening, he's going to be broke. Once you start withdrawing money out of your assets, out of your money down here, I can tell you how long it's going to last. And making your money last as long as you do is the key of today's topic. So it doesn't matter if you're rich or poor. What really matters is what's your lifestyle and can you afford it? So, longevity is something that everybody wants. We're going to talk about this thing. Let me show you this right now. Let's share my screen one more time. So for those of you on here already, what I've got this brochure here. Do you see this? Will your money last as long as you do? So this is a multi-page document. It talks about, and we're going to go through this thing page by page. And if you want, call us 949-219-0692 after the program, if you don't mind. And we will take your name. We can email this to you because it's an electronic format, or we can mail it to you, whatever you prefer. So just let us know, and we'll take care of that and get that out to you. But that's kind of the base of today's Financial Defense Make Your Money Last program. 949-219-0692. You got any other questions that we don't cover? That's fine. But longevity, it's a blessing and a curse, right? I meet a lot of clients who wants to die. Nobody wants to die young. I mean, everybody wants to live as long as they can. The problem with longevity is that it's going to cost you more. Not only your basic costs of living, food, shelter, clothing. I'm sure you don't buy as much clothes the older you get. You've got enough. but food and shelter, there's still, even if your house is paid for, you got property taxes and insurance, sometimes homeowners association on top of that. And then, and those things go up, they keep going up in cost. And then the longer you live, if you live 5 years over life expectancy, which for a 65-year-old male is 85, and for a 65-year-old female is 88. So that's half. And if you live longer than that, 5 years longer, well, that's 5 years worth of basic expenses. But now we've got this thing called inflation. We're all aware of what's going on with inflation. These prices are going up. Last year, they averaged around 9% higher than the year before. And now we're still ticking at about a 5% inflation over that. What that means is that coming into 22, December 2021, if you spent $1,000 on some goods or services by December 31st of 22, just 5.5 months ago, that same $1,000 worth of goods the year before cost you about $1,100. And now we're pacing where, inflation's coming down. Well, okay. That means that prices are only rising at a 5% year-over-year rate, not rising at a 10% year-over-year rate, which means that $1,000 worth of goods at the end of 21 that cost you $1,100 at the end of 22 is going to be $1,150 by the end of this year. Some consolation. It doesn't seem like it's going down. It's just not going up as fast. Prices were going like this. Now they're going like this. So, whatever. And if the longer you live, the more inflation. Guess what else happens the longer you live? The more health care you're going to need. The more doctor visits, the more things that could go wrong. Speaking of things that could go wrong, what about the stock market? The more bear markets. Yeah, there's more good markets, but there's going to be more bad markets that you have to live through. More inflation that you have to live through. More of everything that you're going to have to live through as you continue to live longer. So costs will continue to go up and you need more money. Are you prepared to live to, let's say, 90 or 95 years old? You've got to really prepare for that. Last month, I talked about the centenarians, that in 2000, I think there was about 100,000 centenarians. Those are people who live to be 100, a century, right? They're saying by 2050, that number is going to be about 1.1 million, about 1 million more people. And you say, oh, 2050, that's a long time from now. Okay, well, how many years is it? It's 27 years. So if you're 73 or younger, you got a good shot at making 100 years old. That's what we're talking about planning. Now, back in the day, right, in the kind of my parents' age, and I'm 61, I'll be 62 soon. You had the three-legged stool. Everybody remember the three-legged stool? There were pensions, Social Security, and that third leg was your own savings, right? Pensions, Social Security, and that's why it was a stable stool. Like the piano stool is three-legged, and it's very stable for the person to play great, concertos, etc. So the point is that three-legged stool, other than if you're a government worker, has become at least a two-legged stool, and some of it's questionable at that. Meaning that the pensions on the public sector, the private sector, where you work for a company, those have gone by the wayside. Very few people have pensions anymore. Very few, unless you're a government worker. Hey, by the way, I'm going to redo this. If anyone has a question, you do Q&A or chat, and I'll read the question out to everybody. So that's one of the problems. It's an unbalanced stool. You're wobbling around now, trying to balance yourself, and the onus is upon yourself to save your own money in your 401k, 403b, 457 plan, or just a supplemental plan, or an annuity, or a mutual fund, or something. You need to save for your own retirement. How many people are doing that? Well, a little bit more than half, but not 100% participation on that. It's a low number. So that's what's making individuals more skeptical about their financial future. So how do you solve that problem? Well, knowledge. So appreciate everyone joining in on this webinar, but knowledge and action. It's not just knowledge alone, knowledge and action. You got to have an understanding of options and what your financial future is and where you are today. It's like taking a trip to New York. I mean, how do you get there? There's a lot of different ways. I mean, you can go all the way through Asia and over Europe, to get to New York. I don't know if that's the quickest way, but you could go by foot, you can go by boat, train, plane. There's a lot of different ways to get there. So you've got to figure out with your financial path, how are you going to get there? And then action. Well, if you don't ever leave, you're never going to get to New York. So same thing. There's a lot of people who have plans. I see it all the time. I meet with people every single day and review portfolios. A high number of people are not prepared. They don't know what they have. I didn't check to see who's all on here, but I had a woman in here the other day, and she had 1/3 of her money in one stock. It was her former employer. Again, and it was a good company. I mean, a good company. It really was. But she's 74 years old with one stock with 1/3 of her retirement money. No, I mean, I'm a financial professional. I would never do that. And yet here she was, not even watching it on her own. Then she had another third in mutual funds that were stock oriented. So 2/3 of her retirement, 74 years old, no one's watching it in the stock market. And I asked her, do you consider yourself conservative, moderate, or aggressive? And she considered herself conservative in mind, but in action, she was aggressive. So knowledge and action are the combination to change your financial future. And it's very important that you make those decisions. It's very, very important. You got to identify your unique situation and make unique changes, because, to delay is one of the biggest problems. I see people who have misguided optimism. They have too much money in the stock market given the economic conditions. Now, with that said, I'm going to digress a little bit, and we can talk about the stock market, all till the cows come home, and I'll take your questions on that as well. But I'm still cautiously optimistic. Historically, this period, remember there's this old saying, sell in May and go away? Go where? I mean, why? What does that mean? What it means is historically between May 1st and October 31st, the market historically, taking 100 years, has, maybe about a 1% return during that 6-month period of time. And if the market returns somewhere between 8 and 9% historically, that means 7 to 8% of the returns happen between November and April 30th. So when they say sell in May and go away, it's tough. Now, my own personal barometer, and by the way, the last, I think, 5 or 7 years, that hasn't been true. The May through November period's been better, but when you take 100 years, it's like tossing a coin. If you toss a coin, 10 times, are you going to get 5 heads and 5 tails? Probably not. Now, if you did it 100,000 times, you probably get 50,000 heads and 50,000 tails. Law of big numbers. So same thing like right now. It doesn't mean it's always, the market doesn't have a calendar, but this is kind of that seasonally tough time. And I will say that the period heading into Memorial Weekend typically is one of the toughest. Gas prices historically hit the highest of the year. Now they're not. I just got gas the other day. But gas prices go up higher into Memorial Weekend, and then it starts to lower. And then and the market tends to be really rough, literally right until about the 1st of July, 4th of July. You get this little summer rally that generally happens. Doesn't mean it happens every year. So we're kind of in the seasonally tough part of the stock market. However, since there's so much negativity out there on the market, there's so much people, so much money on the sidelines, there's so many people predicting a recession, so many people worried about the debt ceiling, which is a good worry. But in the end, there's trillions of dollars on the sidelines waiting to go back in the market, that there's so much people, so many pundits predicting the world's coming to an end, that it's generally an opposite side. There was a Sir John Templeton who sold the Franklin Templeton funds. He used to say, when everyone's on one side of the boat, make sure you go to the other. There's a lot of truth to what that gentleman said. That's why they called him Sir John, because he was knighted. But the bottom line is this: is misguided optimism in a negative environment at certain ages is not a recipe for success. It's a recipe for disaster, especially if you're spending down some of your assets from your investments. The other thing is misguided pessimism. All right. Met another woman probably about a month ago. Nice lady, came in, and she was living within her means. She had income coming in, call it like 40 grand, and her expenses were like 36 grand. So she was really good. Today, because of inflation, a silent killer continues to raise prices. It's inflating prices. That's what inflation is. If you take a balloon, it's real flat, you start blowing it up, it's bigger and bigger, groceries and gasoline costs, and that's what inflation is, inflating the size of which prices you gotta pay. She could be in some trouble, but she had quite a bit of money and all of it in cash, none of it in the market, none of it in bonds, none of it in T-bills, you just all cash. So that's misguided pessimism as well. In either extreme, you're out of balance. You're out of balance. What you want to do is have a balanced portfolio based on your risk tolerance, your age, and what your needs are. I mean, needs generally set the precedent first. Okay, so it's really important. So how do you do that? You gotta be defensive in nature. Defensive in nature. Sports teams, generally the best sports team wins championships, whatever it is, whether it's football, basketball, this Miami Heat team, and I'm not, a fan of everybody, they just lost last night, but they played probably the best defense. Wouldn't be surprised to see them win it, them or Denver, that's who's gonna win that thing. But bottom line is that defense wins championships. So when it comes to your investments, very similar. This is what we do here. Is we understand that we cannot control the outcome. The outcome of investments, we have no idea of what's going to happen. I just got done saying there's so much pessimism out there. I would be surprised if things are as bad. But what if I'm wrong? So it's just a casino then. If you can't control the outcome, you might as well just take risk. Well, the thing is the difference between a casino and the markets is you can actually manage the risk, and then not managing the risk, that is, again, too much optimism, because what you want to do is manage your risk. What do I mean by that? When you invest, okay, they say the best way to make money is to buy something at 20 and to sell it when it hits 30. That's it. Lesson's done. We're done for the day. Buy it at 20, sell it at 30. What if the day you buy it, this is a big problem, problem one, it goes from 20 down to 18, 15, 12, down to 10. If that happens, people who bought something for 20 with a $30 price target pretty much have given up on 30, and they're just hoping to get their money back, or even some of their money back. And that's, that's not it, that's hope. That hope is not a good investment strategy. You don't want to be hoping as you're losing money. So what you want to do is manage the risk. And in most places right now, you can buy a sell order below the market, a safety net, a stop loss, whatever you want to call it, because you can't put a stop loss on a mutual fund, but you can still have a safety net on it. And let's just use, for example, $18 a share. And so you're risking 10% of the money you put on there. And if you're smart, when you position size, you have 100% of your money. You don't go and put 100% of your money on one idea, 20, hoping it goes to 30. You should divide that up into 20 equal positions. Now, if you're really aggressive, you can maybe go with 10 of these, but I wouldn't go with less than that. But 20 equal positions at 5% each position. So now let's use $100,000 as an example. So that would mean $100,000 is all your money. You put 5,000 on this position, and you're hoping it goes from 20 to 30, but if it goes down before you get rich, you're going to lose 10% or $500. Now, if you lose $500 on your $100,000, okay, then you still have $99,500 left over to fight another day, because what are you doing? You're position sizing to manage your risk. And then when you invest, you're pretty much saying plan A is that it's going to go up. But you know what? I'm a smart investor. I'm going to have a plan B. What if it goes down? And I'm going to have that plan B before I invest. And plan B is to limit your risk. Don't just hold and hope. I actually fear when we're losing money, and I fear that I made the wrong choice because I thought this thing was going to 30. So I'm not going to hang in there and take a big loss. Remember, Warren Buffett said rule number one is don't take big losses. Rule number two is see rule number one. And if you looked at the invitation for this event, I said misguided optimism, importance of financial defense, don't take big losses. Well, how do you do that? You divide your money up through position sizing. Now, I see people all the time when it comes to position sizing, they'll have 50,000 in one thing, they'll have 20,000 in another thing, and then that last 30,000, they'll have it in 10 or 12 different things. It's like, gosh, so they have $3,000 to $5,000 investments, and some is 30,000 or 50,000. Did they like something 10 times as much? I think they just don't have a strategy. So you've got to have a strategy. If you want to make your money last, and you want to play financial defense, you have to have a strategy where you either use guaranteed investments, which we do over here at Pacific Financial. You're a client of ours, we do that. Or when it comes to risk, we manage the risk by using something called stop losses. Now, when you go back in and you say, okay, well, that's all well and fine. I don't want to lose money, Jerry. Why are you talking about losses? So now you've got the same chart. This is outcome number 2. You buy it at 20 and it's going to go to 30. Let's say it does. So you originally had your stop here, but as this thing goes up and comes back down and the low isn't as low as the previous low, and then you surpass the previous high, you can raise your stop to what you paid. So now all your money's protected. And then you keep raising this each time this gyrates up. And so now you've got your stop loss up here, maybe at $25 per share. So you have a $5 profit kind of locked in, even though the thing's at 30. Because should you just sell it at 30? I mean, you kind of sound like you fear that you're going to lose your profit if you just sell it at 30. I fear when I lose money. But what I do is I hope when I'm making money, and by having that rising safety net, rising risk management plan, this can allow me, if the position is still good and it's going to go to 40, 50, or 60, to stay in there. But people ask all the time, they go, well, what if your stop's at 25 and you go down to 25? Well, if you've got your stop at 25, you sell it. And the number one question people get is, but what happens if it goes up? You mean after you sell it, what happens if it goes up? You lose opportunity. You lose the opportunity. And you have a chance to buy it back, but let's say you never bought it back, you lose opportunity. But if it kept going down, you know what you lose? Real money. I'm imagining that most of you folks on this call right now are on the call because you have a fair amount of money. And I'm also thinking that most of you, because you somewhat at a more senior level age, because that's why you have money. You've gotten through having babies and raising families and having the boat and having the third car, etc. So what's more important to people like us? Opportunity or protection of capital? Most of my clients want to protect the capital. That's what don't take big losses means, is how do you protect your capital in an environment that's somewhat sketchy. We had a bad year last year. So far, year to date, I mean, the NASDAQ's up, which is more your aggressive stuff, but the Dow and the S&P are up, modestly, but they're up and they actually look fairly attractive. So it's very important that you understand that you should always have a risk control on your investments. Either use guaranteed investments, banks, bonds, and insurance companies, or you can use some sort of defensive mechanism. So it's really important. So, what else is the issue? Well, we talked about costs, rising costs. One of the biggest costs out there is healthcare and taxes. Depending on your health, could be number one for some people. That taxes is the number one cost. For some people that have poor health, healthcare is the number one cost. You want to try to minimize, have a plan that minimizes tax risk, and you've got to have something in place to try to help you with your healthcare costs. You've got to identify a plan. And I'm not even talking about long-term care. I mean, long-term care is even more scary. It's in this brochure that I recommended. I'm kind of paging through it right now. Here this talks about the long-term care costs. I'm going to go through a couple of these. It says there's about 70 million baby boomers. That's a lot. The population of the United States is 330 million. 70% of Americans 65 and older, that's mostly the baby boomers, are expected to need some sort of long-term care. Sometimes it's just getting out of a hospital. My mom fell, broke some ribs, broke her pelvis, and doing better now, but she had to go into a skilled nursing facility for a little while, just a few weeks, until she got better to be able to be at home. It says the average duration of long-term care for women versus men is 3.7 years for women and 2.2 years for men. I think that's on the high side. But 3.7 for 70% of half of 70 million. So that's what, 35 million times 70%. It's about 22, 23 million people are going to end up in some sort of long-term care facility. It says 20% of those who need it are going to be in long-term care facilities for 5 years. How are you going to pay for it? Have you figured that out? I'm not saying to buy long-term care insurance. I mean, if you're on this call, you may be too old to be buying it. All right. So you want to self-insure. So that's great. I mean, 80% of people do self-insure. How do you self-insure? You identify the asset and you write it down, and you either share it with your potential future caregiver, or you at least tell your caregiver. This is really important. I had a client not too long ago. We were sitting down, former Newport Beach police officer, retired for a lot of years. This guy's in his mid-80s, and he says, yeah, I was talking about beneficiaries and caregivers, etc. And he goes, yeah, I got my sister doing it. Your sister, how old is she? Well, it's my older sister. She's 87. She have the ability to do this? Oh, no. I mean, you got to get somebody else. So you got to go out and ask somebody, hey, by the way, I'm putting you down as my caregiver. And there's multiple caregivers. There's financial caregivers and there's medical caregivers. They don't have to be the same people. Some people might have a better acumen when it comes to finance. Some people might have a better acumen when it comes to, concerning with your health care. So you've got to have a medical power of attorney and a power of attorney regarding your financials as well. Could be the same person, but nonetheless, you want to have that in writing and you want to let them know. So now he went back, he went to his nieces, his nephews. This is this Newport Beach police officer. And he came back and he said, well, nobody wants to do it. And no, nobody wants to do it. It's a tough job. It really is. It's very, very time consuming. But, once you identify who that person is and they agree that they'll be your caregiver and hopefully they're, your age or younger, then you need to either let them know, here's all my assets. And some people don't want to share all that. You don't have to. You need to have either your lawyer, your financial advisor, some trusted person that has all this, and you have it in writing. By the way, I've got a brokerage account with Jerry Slusowitz over at Schwab. I've got my retirement still with Vanguard or whatever it is. I have, long-term care insurance over here. I own 3 rental properties over there. At some point, you got to show them the goods. And then you got to say, here's what I've got. I've got an annuity with whoever it is, American Legacy or whatever. And I want that money. It's worth $150,000. That's the first $150,000 towards my long-term care. That's what you should use. That's how detailed it needs to be. You either tell that person in advance or you have it in writing that for the person who agrees that they're going to be your financial caregiver, that they know where to go and what assets are going to pay for your long-term care. Because people think that, well, okay, I'm going to be just fine. And then one day I'm going to need to help and I'm going to be able to say, hey, sorry, niece Betty, I need long-term care. Can you come in? We talked about this. Here's my information, etc. Great, wonderful that you know how you're going to end up into a debilitated situation. It's not how it always works. You'd be like my mom, get hit by her own golf cart and slap down onto the ground, hit your head, break your pelvis, and you're completely out of it. Your person's going to come in if you haven't discussed this in advance. What do I do? Doctor's saying, hey, we need to get paid. We need money. We got him in here. We need money. Now what are you going to do? So it doesn't always go the way you plan it is. That's why it's always better on a nice holiday weekend, like Memorial Weekend coming up. Sit down, have a family meeting with whoever's going to be your caregiver and talk and say, hey, look, I want you in charge. I've got this all written out. Here's the name of my attorney. Here's their phone number. That's where all the documentation are. Here's my financial advisor. Hey, I've got some other monies over here that I manage personally. And you got to let them know. You don't even need to tell them the amounts. You just say, hey, look, if something happens to me, that's who you call. And your name's in with all of them. So it's very important that you have that figured out, because the average stay now in nursing homes, they have these little facilities like a home, someone's old home they converted. You maybe get 5 or 6 bedrooms, and it's about $6,000 a room. You eat together. They have cooks and all that. There's no nursing. There's no any of that stuff unless you have your medical program sending people in. Then you can stay in a skilled nursing facility or what do they call those things? Assisted living, 10 to 12 grand a month. And there you get a little bit more service. And then home health care is 20 to 24 grand a month. So there's your cost. This stuff isn't getting any cheaper, all right? So you got to figure out what can you afford, what do you want, write it all out, share it with your caregiver, whoever that person's going to be, because it's really important. 20% of caregivers are over 65 years old. So let's say you don't need a caregiver for another 8 to 10 years, and this person's 70. Well, that caregiver might be 78 by the time you need them. How cognitive are they going to be? What's their mobility issues? How are they? So you've got to really foresight this stuff. And again, you want to make sure you have someone you can trust. This is very important to make sure that they're not taking advantage of you. All right, overcoming inflation. So these prices continue to rise. We've got a sketchy stock market. Sometimes the best thing to do is to just not lose and to participate. We've talked about this. CD rates now for a year are close to 5%. We've got brokered CDs where I could shop the country at FDIC insurance. We see that there's a banking problem going on with some of these banks. If you have more than $250,000 in a bank account and it's not in your trust that has more than one beneficiary, you are in trouble. Do not keep more than $250,000 in any one bank. It's not per account, it's per bank under each social security number. So if you're married, you can have them separate and say, this person has, 200,000, the other person has 200,000. Now you've got 400,000 at one banking institution. But if you have it all under your social security, you're in trouble. Now, if you have a trust, you get the 250,000 times the number of beneficiaries. So if you have 3 beneficiaries on your trust, your 3 children, let's say, for example, now you can have $750,000 worth of FDIC insurance at one banking institution. If you've got questions, call me up, 949-219-0692, 949-219-0692. Be happy to discuss that with you. Hey, before we go on, I just want to talk to you about this. If anyone wants a copy of this, I was featured in Sorbet Magazine. It's the May 2023 issue. They were just talking about me. I did radio for about 20 years. I'm doing some television locally as well. And it says page 14, but I'm actually on page 22. It's not just a fake cover. There actually is some sort of an article that talks about me. So if anyone wants this, we did get some extra copies. If you got one, great. If not, I didn't write the article. Jody, what's her last name? Robinson, she wrote it. So, but I liked it. It was pretty good. Be happy to share it with anybody who wants it. Give us a call, 949-219-0692. Same thing, we can send you the magazine, or we have an electronic version. Be happy to send it to you. But it's really important to understand that with inflation, you want to participate. So right now, we still have, I did a 1-year T-bill, was about 4.9%, something like that just the other day. Shorter term, because the inverted yield curve, you're still getting over 5%. Here's the problem though. Interest rates are starting to fall. I know that you hear, oh, the Fed just raised rates. The Fed controls the overnight. Overnight is one night. The 1-day interest rate is what's controlled by the Fed. But if you buy a 3-month CD, that's longer than 1 day. And then if you go to 2 years or 5 years or 10 years, you do a mortgage for 30 years, those rates are not directly tied to the Fed. We're seeing interest rates drop a little bit here. I'm going to show you that as a matter of fact. That would be a good share right now. Perfect. I don't have it on. There we go. Did that go to the S&P or not really? It's on the S&P 500, right? Okay, so you see the market. I mean, basically, this is the S&P 500. It's really since, August of last year, really September of last year. What's it doing? It's going sideways. I mean, yeah, we're on the high end of sideways, but it's really been going sideways. So if you're collecting some dividends, that's okay. Well, let's look at interest rates. So this is the 10-year Treasury. Oops, 0. There we go. This is the 10-year Treasury. So you saw last year, this is March of last year down here in the lower left, interest rates rose into October, November, right? You can see that interest rates kind of peaked out end of October, beginning of November. And technically since then, we've seen rates kind of falling off. So now might be a good time to lock in a longer term at these high interest rates, because these levels that we're seeing in here are the highest that we've seen since really about 2005, 2006. So you're looking around 17, 18, 19 years. I mean, we still have 5-year annuities paying over 5% and in the high fours. So you can lock in that 5% rate for a number of years. That's pretty good. And if anyone wants any more questions on it, give us a call, 949-219-0692. So that's the thing about interest rates is you can lock in and protect yourself, because now the inflation rate's around 5% and you can lock in at 5%. It insulates you against rising costs, because if you have, again, $100, your costs are going to go up by $5. You're going to have $105 at the end of the year by owning a CD or a treasury bond or something safe. So you either have risk investments with safety attached to it, stop losses, or use safe investments like banks, bonds, and insurance company investments where your money can be protected. And that's the best way to overcome inflation. Now, if you want to take risk and say, okay, I think I can beat that, well, then you can start looking at investments that that have a pretty good dividend, or they raise the dividend on a regular basis. And we're back to me, right? Aren't we? And so you can look at things like, simple one. I'm not recommending this as an investment today, but here we go. This would show, for example, this is ExxonMobil. So Mobil gas stations, right? Around here we have Mobil. Well, look at this thing. Look how this thing has done from COVID on. It's been rising and now it's going sideways, but it's still been in a rising environment. It's only got a 7 PE, and in its last 5 years, 7's the lowest PE it's had, because their earnings are going pretty well and they're paying a 3.5% dividend. So, you're collecting 3.5 and you're getting some growth at a cheap valuation stock. And some of you might say, yeah, but the current administration is trying to outlaw energy, or they want to outlaw pipelines. Exactly. So it's a false scarcity that's being created. And therefore, as long as there's a scarcity, or like us banning Russian oil from the open markets on Western countries, but certainly China and India and Iran, they're all sharing that oil. This false scarcity is what's leading to these things to give you the ability to overcome. Food companies, another way to do that. So, but that all has risk. It involves using stops, or you can go with riskless investments and still get a very good rate of return with no risk if you just hold it to maturity. So that's kind of what you do to overcome inflation as inflation's starting to come down. So again, I still am somewhat surprised we have no questions, and we have no chat. So it's a very quiet crowd. I must be doing a very good job explaining things, because we covered the misguided optimism, the importance of financial defense, the risks that come with living longer. We covered why you shouldn't take big losses and how to protect against that, use safer investments. I mean, I see people all the time, oh, but I got blue chip stocks. Okay, so on the high risk end of investments, like if this is your investment scenario here, got the whiteboard again. Okay, so these are no risk down here, right? Do we see that board I'm looking at? Okay, so no risk down here, which is banks, bonds, if you held to maturity, and insurance companies, and then you got REITs, something like that here, real estate investment trusts, and BDCs and closed-end funds and preferred stocks, and you've got all convertible stocks, and then you got mutual funds. Now you got stocks. So you got your more conservative stocks over here, your moderate stocks over here, and your aggressive NASDAQ stocks over here. Someone says, well, I've got conservative stocks. Yeah, but you're missing the whole risk thing, because the risks go higher, on this scale. So you're on the low end of the highest risk investments there are. So many people ignore the world of income. And this is the world that I live in. This is the world that my clients want to live in. Why? Because it's safer and it creates income. And that's what's really important. Sandra. Good to see you. Thank you, Sandra. Stocks, GE keeps going up, healthcare and AI. Okay, so let's look at GE. Thank you for that question. GE is the old General Electric. Look at this thing. I mean, what a run this thing's had. Do we, hang on for a minute. I got to do a new share. Hold on. Thank you. Hold on. Screen share. New share. Here we go. All right, you see General Electric names up here? Okay. So it's got a 39 PE. Be careful. I mean, they're only earning $2 to $4 a share. Now it's had a good run. It went from 48 to over 100. So it's doubled since basically October. And if we go longer term and we look at this thing now, this is back in 2018, there's 2019, there's 2020. And you can see this thing was going down, really was going down for a number of years. And then it kind of tried to peak back up and then it went back down again. Now these old highs right over here, this is back, well, so it's overtaken it. These were $90 highs and we're higher than that today at around 100. So we go back a little further here. And now you see GE back in 2000. Okay, that's way back when it was $400 a share. So you're still down 75% from these old highs. And you can see that this probably has a price target, could be as much as $130 a share, $120 to $130 a share. I wouldn't be surprised if it got there. Okay, so it kind of formed one of these patterns, tried once, they tried twice, tried another time, and then boom, it just popped right through. So I like GE. They are diversified. It's pretty good. And then healthcare overall, though, let me show you this. This is the Healthcare Exchange Traded Fund. It's XLV. And you see that? So this is a mutual fund, an exchange traded fund of all healthcare stocks that are in the S&P 500. And you can see this peaked at 144 back at the end of last year, end of December, beginning of January, went all the way down to 123 and then came back to 135. And you see even today or this week, it's gapping down. I wouldn't be surprised to see this thing go even lower, as much as low as 123. So the sector itself, Sandra, isn't really doing all that good. But GE, which is a diversified company, is. Okay, so you asked about AI. Okay, so here is an AI stock. I think this is the C3. I think they're ChatGPT is who I think they are. And again, you can see it was going off. And then this is when the first round came out, went down, came up, went down, went even higher, went lower, and now it's trying to go back up. So if we ignore the tails, it's trading between $20 and $30 a share. We're at 27. I wouldn't touch it. Okay. Now there's a couple other ones. I've got a list for this. Let's see, it's right on the top of my list. So there's this exchange traded fund. None of these are recommendations. I'll go on record. I'm not recommending any of this stuff. All right. But here's a global robotics and AI exchange traded fund. So it's a mutual fund of a lot of these things. And you can see it was having trouble with 25, and now it's popped above it on pretty good volume. So AI, is looking like it's going to work. Here's another one, AIEQ, which is AI powered exchange traded fund. This one doesn't look as good. You can clearly see it's going in a downward direction. Microsoft is something I own. They're going to use artificial intelligence. It's doing well. Google also is using artificial intelligence, doing well. There's another exchange traded fund. So this is going to have a bunch of stocks in it. It's called Robo Global Robotics. It's Global Robotics and Automation Index, AI. Kind of going sideways. So none of them are running away from you. There's a social media ETF, social media, like they know everything about us. They're probably listening in on this conversation. They're listening in on everything we ever do. And even if you're not a social media person like me, I'm not. But, we have some presence out there. I'm sure that they follow it. So my point is, and here's one last ETF. It's the WT AI and innovation. Same thing. None of this stuff is running away from you. None of it. So good question, Sandra. But I'm not a big, huge fan right now of AI to own it. All right. Some other questions came in good in the chat. What happened? There they are. Carl, are bond funds still bad investments due to continued rate increases? Yes, Carl. I mean, look, I don't see interest rates coming down yet. Some people are going, oh, the economy's going to hit a recession. They're going to have to lower interest rates. Maybe. I mean, I think there's so many people talking about a recession that maybe we don't have a recession. I certainly don't see it. I mean, the jobs numbers are all pretty good. Our purchasing managers index for services and manufacturing are still above 50, doesn't show contraction. And in the housing industry, there are more housing construction jobs today than ever in history. Ever in history. That doesn't look like a recession to me. And you know, you've got plenty of people on the sidelines who can take these jobs. So, you know, I don't see it. So one more time, I'll do the screen share on this. Here we go. Another page. Just remember that interest rates and prices are directly inverse. So if interest rates go up, okay, if interest rates are rising, bond prices are falling, okay? And now the Fed said, we're going to pause on interest rates. I showed you the 10-year. I said, well, 10-year looks like it's going down. Maybe I should show you that one more time. So it's not as clean. Oh, goodness. Bear with me. Here we go. Hopefully you're back onto my stock chart screening thing, right? So I'm going to go a little further out now. I'm going to actually go way further out. And you can see these interest rates. This is back in 96. Here's 2000. Here's 2005. So interest rates were way up here for a long time. And, you know, then they fell and went up a little bit. And then this was COVID way down here. This was a 200-year low on interest rates. And you would see that, you know, yeah, it looks like it might be pausing, but this is a flagpole. There's the flag, and there's the pole, there's the flag. Historically, when these things break out, they break under or up, the higher propensity to be in the same direction of the flag that it would be going up some more. So, you know, I wouldn't be buying bond funds. Why? Why would you? When you could buy other things that are going to pay, you know, 5% or better with no risk, and you own the maturity. All you got to do is hold it to maturity, and you get all your money. You get out early, you might make money, you might lose money. So I don't like bond funds right now. There's just no reason to buy them. Here, let me show you this other bond chart right here. Should have shown it to you before, but let's go with it. So this is the U.S. Aggregate Bond Index, AGG. It's an exchange traded fund. This is like a fund of all your bond funds. You can see interest rates since July of last year are still causing prices to decline. Okay, you're still seeing overall prices decline. You know, they're on the high end, but they're actually kind of almost midpoint now. So you see that they're going down in price, and that's not good. You know, so you don't want to own a bond mutual fund because you don't own the maturity. I think after a 40-year period of falling interest rates from the 20%, 19% CDs back in 1982 to like 0.5% in 2020, that period is over, and we're going to start seeing inflation. And to some great degree, let's talk about the debt ceiling briefly. With the debt ceiling, remember the cost of that debt. Okay, so we're $32 trillion in debt, and the 10-year Treasury, as I just said, was 3.5%. Let's call it 3.72. So if you're talking about 30 times 3.7, you're talking about $1 trillion a year, 1.1 trillion, just to service the debt, just to pay the interest on the debt. 1.1 trillion doesn't go towards any parks, any national parks, any military adventures. It doesn't go towards Social Security, Medicaid, Medicare. It doesn't go towards any of those programs. It goes to pay the debt service. So as interest rates get higher, the amount of money that gets taken out of circulation for good use becomes oneristic on the overall economy because we're just paying debt service. So I think we're gonna get stuck with some inflation because they don't want to keep raising interest rates to some, untenable ending, because that's going to adversely affect the debt service. So we're just going to have, more stable, high interest rates. We want to call this high on the historical basis of, let's say, my lifetime of 60+ years. These interest rates are still very, very low, which is why housing hasn't really slowed up to these 6%, 7% mortgages. All right, so hopefully that answers the question. What are the best income suggestions? Well, I've given you those. I mean, I would look at some of these annuities that are 3 to 5 years. I would stagger out your maturities is what I would do. I would look at, let me share this again, back over to here. Is that what you want to do? Is you buy a 1 year, a 2 year, a 3 year, a 4 year, and a 5 year. And so each different thing, you can look at, again, banks, bonds, insurance companies, whatever pays the best. Corporate bonds are starting to be good. Let's say you had $500,000, whatever that number is, you divide that by 5 equally, you put $100,000 into each maturity, and then that way there, a year from now, you can do this 6 months, 12 months, you can do it 3, 6, 9, 12 months, you can do it any way you want. But the longer you go out, generally the more stable your money is going to be. So now a year from now, this will mature, okay? And this, instead of being 2 years out, will be a year out. This will be 2 years out. This will be 3 years out. And the 5 year will now be, since a year has gone by, it'll be 4 years out. So you have a choice. You now have 100 grand. You can spend the money, okay? Take the money and you have a liquidity event, or spend some of the money or none of the money, and then you buy back into this 5 year ladder. And you're buying whatever the highest interest rates, because generally we won't have an inverted yield curve. This inverted yield curve is the longest one we've had in history. It's been, I don't know what it's been, 20 months. Excuse me, been a long time. I've never seen one last this long. But what happens is you can buy into that longer term time, or you just take it, and then another year, same thing. You have the same thing. You can spend the money, and now this 5 year will be a 4 year, and everything will be down, and you just keep laddering this, whether it's out to a year or out to multiple years. So that is the best income idea I have. And you use banks, bonds, or insurance companies. Do not use, and again, if you want risk, obviously there's stocks. I mean, stocks, closed-end funds, that's what I specialize in. I specialize in creating income portfolios. So that's really important. Okay. And then if you like AI, we're still back on Carl's question. Would you stick with Google and Microsoft? Full disclosure, I own both of those in our growth accounts. Hopefully this came on. There's Microsoft, and you can see Microsoft has done well, it's in a rising uptrend. And if you look longer term, you can see this thing was going down, stopped going down around here. That was a good time to buy it. And now you're catching the uptrend, not much of a dividend, 34 PE. Forward P of 28. The 5 year range has been 23 to 41. So it's fairly valued. It's not a great deal anymore. Here's Google. I will buy the one with the L on it. It's just a share class. If you compare the two, Google with the L, it's done slightly better. Same thing. Stopped going down. You had a recent time to buy it. It's popped up nicely. It's got no dividend, 27 PE. It's on the cheaper end of its 5 year range, 17 to 44. So Google's probably a little bit of a better buy than Microsoft right in here. Like them both. None of those are for income. And again, they're not recommendations. All right. If you want more information, just call my office. 949-219-0692. Jeffrey, do you think the government is going to default? If so, where do we invest? Hold on to your seats. Hopefully, if you have stocks, you have stop losses on them, and I would let those go. They hit the stop, let them go. Zero cost to buy, zero cost to sell. If you're paying a commission more than zero, transfer your accounts over because you're getting taken. But zero cost to buy, zero cost to sell. Have a stop in place. But do I think the government's going to default? Maybe momentarily. I mean, they could be 3 days late or 5 days late just to teach somebody a lesson, a political lesson, not any kind of serious lesson. There's nothing to be learned here. But I'm going to go back to my example at the beginning of this call about this very wealthy gentleman that I'm taking on as a client that has this $20 million sale of his business that's going to run out of money in somewhere between 20 and 22 years. This is the debt ceiling discussion. So this is not political. I don't like any of them. All right. I really don't. But people are saying, oh, we got to pay our bills. Guess what? All four, whether it's the Senate leader or the minority leader in the Senate or the House leader or the minority leader in the Senate or the president or the vice president, everyone's saying we got to pay our past bills. No one's saying we don't. Okay. Everyone knows they got to pay the obligations. But the problem is that we're going into debt faster and faster and faster. And for the first time, since they're not in power, the Republicans, who spend just as much as the Democrats, when the Republicans are in power, they both spend equally. So I'm not picking a side. They're trying to put a cap on the spending for up to 10 years. And I think that's a good idea. Why? Rich client, I just got done telling you about it. They're spending $2.2 million a year. They have some real estate bringing in about $1.2 million. So you've got about $1 million left, all right, of expenses. Well, his wife spends $35,000 a month on credit cards. Okay, wait a minute. $35,000, that's $420,000 a year. I saw the credit card bills. I saw the credit card bills. This isn't a joke. She really has done that year in, year out. And she's not buying stuff for the house because they got housekeepers and maintenance people. So she's just spending that money. So is it a good idea for this gentleman worth $20 million from the sale of his house? He lives in Malibu. He's got about a $9 million house and he owns the place across the street. Is it a good idea for him to say to his wife, hey, look, instead of spending $35,000 a month, maybe you should spend $15,000 a month or $20,000 a month? That's a huge improvement. And that's what we're debating now is, oh, we shouldn't discuss future spending when we're talking about a debt ceiling. Yeah, you should. There's no better time than right now when this guy's getting his 20 million. And so that's taking a human approach to a political problem that we have in the federal government. Should they look at slowing down their spending? Absolutely. So will one side hold out? I have no idea. I mean, once it's a matter of who's going to blink, and it's not like we won. The American people will win. You and I want them to try to figure out if the government is spending $35,000 a month on a credit card, we want that to stop, just like this gentleman. So we've got to figure out where the leakage is going because we're going into debt. There's the federal deficit, which is your annual debt, and then there's your debt, which is how much you owe long term. So we've got an inherent built-in deficit year in, year out, that by the end of the year, all the revenues that come in, we don't bring enough, and this has been years. The last time we did not have a deficit where we brought in more than we spent was in the mid to late 90s when Clinton was the president, a Democrat. And the other guy that, what was his name? He was the contract with America, silver-haired dude. He was running the Speaker of the House, Newt Gingrich. Those two worked together, and that was the last time in the 90s. So there've been plenty of Republicans and plenty of Democrats. So if you think I'm bagging on somebody, I am, all of them, okay? But should we put some sort of caps? So do I think that the government could potentially default for a few days? Sure. Do I think that this is a long-term deal? This is all make-believe. This is all politics. These people are all playing politics, and they've got the whole country worked up against each other because we have real problems and real issues that we could solve. And all they're trying to do is assess blame to see which side the media is going to blame. You got to know which side the media is going to blame. It's got to be figured out. So could we go 2, 3 days, 4 days in debt? So what do you do when you invest? Have stop losses. And if you have these guaranteed investments like T-bills, don't worry. Hold on. You'll be fine. All right, Michael, we're getting close to 4 o'clock. So I'm going to wrap it up here pretty quick. Unless you've got a question, the chat or the Q&A, please ask it now. But it says, excluding long-term care insurance, where do you go and how do you fund your health care needs? Asset care policy. Well, yeah, I mean, an asset care policy is generally an attachment onto an annuity. So annuities are great because you know that money's going to be there. Again, not a variable annuity. Variable annuity is very expensive. You can lose money. But if you have a fixed rate annuity, fixed index annuity, those are great sources to fund your long-term care because you know that money's there. you know for a fact that it's available. And most of them, in most states, they have a long-term care waiver where you can either pull out all your money or, like a double withdrawal as opposed to 10%, you can start drawing 20% out. So most of those, that's really a good spot. But let's say it's mutual funds that you have, or let's say, and I know what you've got, Michael, but in the end, let's say it's somebody else on here that, they have some other things. They could identify, hey, I want these mutual funds. Because if you don't identify which assets to sell, that caregiver is going to come in. If you think, oh, you're going to be in a long-term care facility, hey, you sell this, sell that. What if you're incapacitated? What if you hit your head? What if you got a car accident? What if you're like my mom and you get hit by the golf cart, slammed to the ground? You're not thinking. So you better have this written down and say, hey, don't sell my Halliburton stock because I worked for Halliburton for 30 years. Write that in there. But again, if you've got questions on it, you can always call me. I'd be happy to go through your portfolio and say, hey, identify this is your first sale, this is your second sale. Here's 100,000 for year one. There's another 100,000 for year two. There's another 100,000 for year three. And at least identify 3 years worth of long-term care needs. And if there's two of you, you and your spouse. Okay. So hopefully that answered your question, Michael. Any other questions or answers? Any other questions? I'd be happy to answer them. The next event is Thursday, June 22nd. And this is kind of surprising that we had so few questions. Is we're going to do investment basics. I'm going to cover a little bit of Social Security. I'm going to cover annuities by popular demand. People are asking me how annuities work. Some of you know exactly how they work, but there's multiple types of annuities. So we'll cover that as well. I'll have a handout that you guys can get if you want it. By the way, I've got this handout. Just email info at PFP for Pacific Financial Planners, pfpinvest.com. We'll send you this. Easy read. We can send it to you electronically. We can mail it to you hard copy, whatever you want. And then we're going to cover investment basics. And we're going to do kind of more of an Ask Jerry. We kind of do this once a year where it's just more a grab bag of several different topics. And then people can ask me whatever they want. And those generally have been kind of the best ones of the year. But it's mid-year next year, June 22nd. We'll kind of be in the mid-year report card. All right. Any other questions? John, thank you for saying thanks. Any other questions? Otherwise, I'm going to say goodbye for today. See you guys June 22nd. All right. Thank you, guys. Oh, thanks, Ted. Thanks for joining us. Let's take care.